Take the first step towards online privacy. Get NordVPN.
Hi, everybody. I am joined once again by your favorite cigar smoking. I don't even know what to say. Bad mouth. No, that ain't right.
Foul mouth. There you go. That's good. I like that one too.
Smart cigar smoking New York Italian bad mouther.
Not safe for YouTube.
Not safe.
There you go.
Definitely not. Hey, Tom, thank you so much for making yourself available. And
No problem. You know that.
The world is getting crazier and crazier and crazier, and there's more craziness to come. More craziness to come, right? But I've been busy with my social work last few days, so I've not kept abreast with what's happening in the news. But somebody told me that today there's been the markets have plunged.
Yes.
Yeah. Now before we go, I just want to say we're recording this on Friday, the 2nd of August at 10 minutes past 7 UK time, and this is going to go up on the Saturday morning, 3rd of August, and I'll have the links to Tom's website and his Twitter and stuff where he's very rude and entertaining. TomLuongo.me and his Twitter profile. And you should really go join his Patreon. It's really, really good. So, what's going on with the markets? Who did it and why?
The Bank of Japan and the Ministry of Finance is the short answer. That's the fun part. That's the part that I know everybody's like, what? Like, the reason it's the Bank of Japan. Let's back up a bit now. For months or for years now, I've been saying that Japan was going to be the catalyst for whatever was going to come next. And the reason for that is that Japan was moving against the trend. They were starting the process they were the last ones to start tightening monetary policy. And Japan has been the source of global liquidity through what we know as carry trades, where you're long one currency and you're short another, or someone else's bonds, and you're long one bond and short the other. You front run the loose monetary policy of one central bank, and then collect the spread against a tighter central bank, and you can collect the interest rate spread on those two things on that play. And Japan has been the funding currency of choice. They put themselves in that position since the early 1990s. It's been that way for 30 years. So it's been a standard under the market. It's been a thing. Now, it's not always been just kind of a foundational floor. It's not like Japan has not altered monetary policy during that time frame. They have. But in general, it has been manipulating the yen and the price of the Japanese government bond market in order to ensure that they continue to export at the rate that they need to, and just this is how they've been managing their economy, and they've been doing so in a way that drives Austrians mad. It drives like rational people mad. It drives everybody mad. But Japan has been successful at this because Japan is also, at the same time, the Fed's wingman. Now, it is independent, but I've always said that, at a certain level, Japan is this conquered nation and a colony of the United States. So if the Federal Reserve wants to do X, then Japan will alter its monetary policy to support that in whatever manner. Whereas it's very clear, if you watch the ECB and the Fed, they've never really been in cahoots together, unless we had globalists in charge of the Federal Reserve, like Bernanke and Jan. And that was especially the coordination of monetary policy between the ECB, the BOE, the Bank of England, the Swiss National Bank, and the European Central Bank was very clear under the Yellen-Draghi years, right? Yeah. And Mark Carney was at the Fed at that point, or at the BOE at that point, blah, 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 blah. So once you understand all that, what happened this week? Well, as I've been saying, slowly but surely, the guy who's now in charge who replaced Kuroda at the BOJ 2 years ago, Ueda, his name is Ueda, U-E-D-A, Kazuo Ueda. I'm terrible at pronouncing Japanese names because, well, I don't speak Japanese. Even though I do watch some anime, but I mostly watch it in English. I'm a poser, I know this. So to the anime freaks in the audience, it's fine. But now that I'm going deaf, actually, I start watching anime in Japanese because I have to watch everything with subtitles anyway. So there we go. Okay, so maybe eventually I'll become a purist. But Ueda was the guy who was not chosen originally, was not expected to be Kuroda's successor, right? It was supposed to be Kuroda's right-hand man, Kishida. Kishida stepped aside after Kuroda announced his retirement, saying, I've been the architect of this, literally quote, I've been a part of the last 30 years of monetary policy, and we are entering a different era where my experience is not going to be relevant or, in the best interest of the country. And so I'm effectively doing what I'm supposed to, fall on my sword for the good of my country, even though Japan is very much a seniority-based culture. For a man like that to step aside at that moment in time and say, look, I'm stepping aside for the good of the country. That was his way of walking away. The reality is, of course, Japan needed to start tightening monetary policy. And they started by loosening the band on their yield curve control on the long end of the yield curve. Then eventually they started raising rates, and very slowly they intervened in the yen every once in a while. Blah, blah, blah. The Ministry of Finance would intervene in the yen. Now, I've been on this story for a long time. I've got a couple of patrons who know Japan very well, who've helped inform me of what's going on here. I always want to give a shout out to those who have informed my material. And because, like everything else, like we all stand on the shoulders of someone else who's a giant in a particular area. It's part of the reason why you cultivate a community, is so that you have all these voices with which to pick from to figure out who is full of shit and who's not. Well, we've got people who in our community in Gold, Goats, and Guns who are not full of shit on Japan. And so there's, what he said a while ago, he said, look, expect in support of what I was seeing with the BOJ, like, expect at some point that Japan will intervene in the yen market. They will intervene hard. And when they do, everybody will be caught flat-footed because they don't understand what's going on. They don't understand the dynamics. Everybody who's ever tried to short the Bank of Japan and go against them has lost in, it is known as a widowmaker trade in markets. The Kyle Basses of the world, the other CIA assets that are out there trying to manipulate everybody into thinking, oh my God, Japan, oh my God, Japan, oh my God, Japan. Like, yeah, shut the fuck up. I'm dead serious. Like, I've been literally saying for the last 2 years, like, shut the fuck up. This is what Japan is going to do. On Sunday or Monday, they had their latest meeting. The Bank of Japan came out and they raised interest rates from 0.1% to 0.25%. Now, it doesn't sound like much. They're still, quote unquote, at the zero bound. But for a country that was at negative 0.1% for over a decade, I think over about a decade, this is significant. It's like so they had to start raising. They've allowed the long end of the yield curve to start to rise. It's just allowed the yen to fall, which has kicked the Nikkei 225 up to new highs, which has since rolled over, because at some point they were going to have to crush the yen shorts, and they were going to wait. And of course, if you want to get maximum bang for your buck in intervening in a market, you have to let it run to an extreme where there's not a lot of buyers left, or in this case, sellers of the yen at 162 to the dollar, and you got to wait for some buyers to start coming in. And then you start selling dollars and buying yen, and you can get a big move. Now, they've tried this a couple of times, and everybody kind of laughed. Oh, look, the Bank of Japan weekly tried to stop the yen from going to 200. Happened a couple months ago, happened a couple months before that. Like, okay, you wait. Feeling froggy, take that leap. 162, they were going to come in, and they were going to defend the market. Because at the same time, never forget this, and this is very important to understand. The Bank of Japan, through their QE programs, have not only bought bonds, they bought stocks as well.
Yep.
They have themselves covered across every asset class. They own a ton of U.S. Treasuries. They own a ton of their own debt. They own a ton of their own stocks. They own a ton of dollars. Forget their bond reserves. They just own a big shit pot of dollars. Like, their foreign exchange reserves are massive, and they own a lot of dollars. They can dump $40 billion on the market, and they're not even hurting their balance sheet. So they have every asset class they need to manipulate, to affect this turn in monetary policy from dovish or from accommodative to tighter. And they have to do so because inflation is structural. And if there's a country on the planet more allergic to inflation than Germany, it's Japan. And the reason why the Bank of Japan can get away with all this, unlike the US, unlike a lot of other countries, is because Mr. and Mrs. Watanabe, who are the what's the word I'm looking for?
Japanese investor.
They're like the typical Japanese investor, right? They're the mythical, apocryphal Japanese investor. Mr. and Mrs. Watanabe buy Japanese.
Yeah.
They buy Japanese stocks or they buy Japanese bonds, or they, depending on where they are, depending on where we are in the cycle, but they don't buy a lot of U.S. blue chips. They don't buy a lot of European stocks. They don't go running around searching for yield over in Singapore. The Bank of Japan knows this. And as long as the Bank of Japan and the Ministry of Finance can get away with this, all of this crazy monetary policy that offends the sensibilities of so many hard money advocates, is because Mr. and Mrs. Watanabe always get a small positive rate of return on their investment over inflation. As long as government policy is going to give them 1% real yields or 0.5% real yields, they're fine. Real yield being the real yield on their investment minus inflation. That's it. As long as that happens, you'll never see a massive capital flight out of Japan. They know this, and they always alter policy accordingly. And this is why I was never down with the idea that the yen was going to 200. Period. I was never going to go with the first order analysis on this because it was never, once you thought through, it was never going to happen. So in effect, Japan runs a two-tiered monetary system. They have a domestic circulating yen, in effect, even though they have an open capital account. There's domestic yen and there's international yen. There's the domestic price of yen and the international price of yen. And as long as the regulators and the government manage the macroeconomic picture well enough, there will be no revolt. Okay. And because of that, they can start changing monetary policy. They have the assets necessary to move stuff around. So now what happens?
Okay, now hold on a second.
They intervene.
Hold on a second, just so I'm clear, right? Because I haven't looked at the yen dollar price for ages. I can't remember the last time I looked at it, right? So what you're saying, 200. So it's not going to drop. The yen's not going to drop to it's 200 yen to the dollar. What is it currently, and what did they do?
Well, it hit 162 a couple of weeks ago, and then boom. So 162 yen buys $1. Right. So lower number, stronger yen. Higher number, weaker yen. Okay. Whatever's in the denominator is either weakening or loosening, or is whatever's in the denominator is the important part. So we look at the USD/JPY as opposed to the JPY for USD.
Yeah. So they raise interest rates from 0.1 to 0.25, which is tiny, but in percentage terms,
there's that. But what they really did was they dumped $39 billion on the market, and they started to roll the yen over last week, a couple of weeks ago, back into the high 150s, and they couldn't get past that. They couldn't get the shorts couldn't come in and take the yen higher. The 10 years been pegged at one. The 10 years been pegged around 1% plus or minus 2 basis points for weeks now. Now,
okay. So
the other day, in support of this, they dumped them. Let me explain. They dumped them. They dumped dollars on the market. That strengthens the yen because they sold dollars, bought yen.
Yeah.
And now the yen is going to close this week at 146.
Oh.
Yeah, that's the punchline. And after the FOMC meeting on Wednesday, it was trending towards 150 and closed the day at 149. And it's just gotten worse and worse as the day has gone along. Now, because of that, since it's the funding currency and the funding currency of all of the stock market froth is in yen, now there's a whole lot of people who are short yen that are in trouble. They're long dollars in stocks. They're short yen. The yen is rising. They're losing their ass. They have to cover their carry trade, unwind it, and by doing that, they have to sell stocks all across the board. And at the same time, it's causing a massive liquidity crisis across the entire complex because as stocks start to roll over, now everybody's worried that there's a stock market meltdown. So now they're running into bonds. We've got a 40 basis point move in the whole U.S. yield curve down, right? The U.S. 10 years going to close this week at like 3.8. It was trading at 4.35 at the beginning of the week, or 4.25 at the beginning of the week. We're down into the 3.8 region on the U.S. 10 year. And that's its own story. So that's another story. I just published a podcast like literally an hour ago with Vince Lanci, and we went over all this shit last night. Vince and I, we recorded last night. I just published it, I don't know, about an hour ago. And everybody should listen to episode 186 of the Gold, Ghosts, and Guns podcast because Vince and I go through 4 major stories, and they're all related. The yen, Yellen and the bond, the bill bond, the Yellen's manipulating the yield curve by selling bills and not bonds and all of that stuff. And it's really important. What's happening here is now that all happened, and the U.S. economic statistics this week after the Fed refused to cut interest rates on Wednesday meant that we had to put out worse than for political reasons. You saw really bad employment data come out of the U.S. this morning, and everybody's like, that's why the markets are melting down. That's part of it. The other part of it is that we're in the middle of a friggin' Mr. Margin call is knocking on a whole lot of people's doors, and someone's trying to get the cash before the weekend. So they're selling their frothy stocks. We saw NVIDIA nearly rolled over and threw a Widowmaker friggin' bar for the month of July. They saved it on the 31st, going into the close. It was retarded, but whatever, fine. And like, okay, they paint the tape, and then next month, and then August starts, and NVIDIA's selling off again. So, all of this stuff is happening against the backdrop of Israel, Iran, and Hezbollah, and this, and then all of this stuff's happening. But now we have an honest-to-God potentially financial crisis. And I have to wonder, and Elizabeth Warren's out there screaming this today, the Fed should have cut rates the other day. It's irresponsible. Well, yeah, you're losing your ass and you're going to lose the election, and that's what you're worried about, you fucking commie. You horrible, horrendous human being that you are. You know fucking damn well that this is what's going on. So as far as I'm concerned, Powell didn't have to cut rates on Wednesday because the BOJ raised on Sunday. The Fed is okay with capital markets taking 15% off the top. Capital markets in the US were all trading at all-time highs.
Yeah.
The Russell 2K just broke out to a new all-time high. The Dow, the S&P, the only one that didn't was the NASDAQ. And the NASDAQ didn't because NVIDIA started to roll over at the beginning of the month. So now, let's do some math. Let's do some math. Now let's talk about where we really are. The Fed's okay with having the stock market roll over before the Fed cuts rates. As Daniel DiMartino Booth has been banging her shoe on the table like Khrushchev about for the last month, you have to understand that if the Fed cuts rates, it's going to cause the stock market to crash, not the other way around. The conventional wisdom, which is wrong, because people always get this wrong because they've been taught wrong, and they've been taught wrong by people who are intentionally teaching them wrong. I'm really trying not to get unbelievably angry about all this. You have no idea the depth of my derision for this, but the depth of my hatred for all of this. I mean, I can't make my face more angry about how people have been mal-educated about fucking markets work. Okay, because it's really simple, folks. Markets don't trade on these stupid correlations. They trade on the intention of what the correlation means, i.e., rising bond yields. The Fed raising interest rates means they're worried about the economy overheating, and they're trying to slow an overheating economy. Therefore, the stock market's going to rise because the Fed is saying, we think the economy is strong, and we're trying to make sure that it doesn't get out of control and inflation come out. So they raise interest rates. That's supposed to be bad for gold. It's not bad for gold. Inflation is incipient. The Fed is trying to keep people from running into gold because inflation is on the horizon. And so gold goes up with rising interest rates, even though everybody will tell you that gold is, supposed to be inversely correlated with rising interest rates. No, gold is inversely related with high real interest rates, meaning if the Fed funds rate or the yield in the bond market is 3 points higher than inflation, gold's going to be in a bear market. That makes sense. I can get 3% on my money. Why would I park it in gold, which quote unquote gives me no yield? So it's all correct, but it's all presented wrong, intentionally backwards, as far as I'm concerned, to put people on the wrong side of the trade, to fleece the fucking Muppets.
Yep.
Which is what Wall Street thinks of everybody and what all the friggin' technocrats think of everybody. Next, on the other side of the trade, when the Fed cuts interest rates, it's because it's worried about a recession. So therefore, are you expecting corporate earnings to expand? No. The Fed the stock market will turn around when the Fed stops lowering rates and starts threatening to raise them. What's the Fed now ready to do? They're threatening to lower rates. They had the Bank of Japan come out and raise rates and intervene in the end market to blow up a whole bunch of fucking bullshit carry trades that should have been unwound years ago. As a precursor, this is all happening according to the plan. My thesis about what's going on is completely fucking correct. And what you're seeing right now is a massive safe haven trade. Everybody's moving into dollars, they're moving into gold, they're moving into U.S. Treasuries. We'll see the Dow pull off a little bit, and then the Dow is going to run right back up. And in the short term in Europe, we're seeing the same thing. The euro's up. The DAX was up on this today. The German bunds were up today. It's not a long-term plan. At some point, once people are worried about Mr. Margin Call and they're past Mr. Margin Call, then they're going to figure out what they need to do. And they're going to deploy their capital. And do you think they're going to deploy their capital in Germany or the United States? And I'll take this one step further. Ready? Who gets blamed for the financial crisis? Sitting government. The Fed's not political at all. But the Fed's going to hold interest rates at 5.5% to ensure that Kamala Harris doesn't become president, and that all these freaking commies are removed, and all these people who are threatening to revoke the Fed's charter are removed. Even if you don't believe in the Republican versus Democrat divide here, let me put it to you this way: the Elizabeth Warrens and all the rest of them that have been screaming about the Fed and how they're irresponsible, and how George Soros is putting all these friggin' talking points into AOC's mouth and all these other friggin' literal mouth-breathing morons. Like, AOC doesn't even know what the fucking Fed funds rate is. Okay? Like, really? The bartender from the Bronx. Really? Okay, fine. I have two legs. One of them, if you pull on them, plays jingle bells. You pick which one. Because fuck you. Now, next. Yeah, I'm in high dudgeon today, Rich. I got a lot on my mind.
You're good.
So,
You're good, Tom.
So
I got a front row.
If you think for a moment that the Fed's not going to turn around and go, oh, really? You're going to threaten our charter? Fuck a whole lot of you. 5.5%. Higher for longer. Not cutting rates until after the election. You better steal the election. And you better steal, and you're going to have to steal it in such a way that everybody's going to be like, okay, this is bullshit. And of course, what they're hoping for is the same thing that they've got going on down in Venezuela, that, Maduro lost so badly that, finally he lost so badly that we can't tell if it's just, he actually lost the election or it's a color revolution, and what a shock. It's a little bit of both, folks. Like, come on. Like, and we've got the same, and they're trying to brew the same, potion, shitty potion here in the United States as well. It's nothing new. All right, I'm done. Okay, I'm finished. It's like the Canadian guy from, can I finish? From South Park. Finish? Okay, I'm finished.
Oh.
The only thing I don't do is I don't have my head go up and down like the flappy-headed Canadians from South Park. Oh, that's hilarious. I'm sorry.
Okay, so that's it. So then,
in effect, Rich said, "Hey Tom, how are you?" A half an hour later.
Oh, Tom, it's a good thing I'm a social worker. I'm used to listening. Okay. Europe. How is Europe going to react to this? What are they going to do?
They have to cut rates. They want to cut rates badly. The markets are screaming for the Fed to cut rates. The banks are all out there screaming to cut rates. Why? Because the economy is seizing up here in the United States. Of course it is. But I want everybody to honestly ask themselves a simple question. Will the problems of the United States government and of the United States economy be saved materially by a shift from 5.5 to 5.25% 6 weeks earlier than later? No. Can we please dispense with the bullshit? This is about a big bank or somebody going broke in the next 6 to 9 weeks. That's what this is about. My bet's on the Bundesbank or some other Davos Wall Street bank, or, Davos related Wall Street bank, or the election, or this, or pick any number of 1,000 different potential issues. And, that's what we're looking at. Right. Okay. So
now, Tom, I've said this to you before, right? A lot of the intricacies of the stuff that you talk about, right, goes above my head, but I can get the general outcome of it. Right. I don't have the expertise and the training and the education that you've done. Right. But I can get and I've learned a lot from you, a hell of a lot about finances. So if the European Union cuts rates, that's just going to accelerate capital flight. You've got the risk of war going up.
Right. Yes, you have the collapse of these carefully orchestrated credit spreads between Germany and the U.S. and Japan just blew all that up, because all of these carry trades are all based on the currency exchange rates staying in a very tight range.
Yeah.
Because remember, understand that when you buy a bond swap, right? So you sell a Japanese, if you sell a Japanese bond to buy at 0.1% to buy a U.S. or at 1% to buy a U.S. bond at 4.5%, you're making 3.5% on the spread. Ceteris paribus. And what are the ceteris paribus means all things being equal. Well, we know one thing. Nothing is ever in equilibrium. So ceteris paribus is a condition that never exists because all things are never equal. As long as the currencies don't move more than 3.5%, that's a profitable trade. The minute the currency moves more than 3.5%, you're upside down in value in your currency on the trade because you spent 1,000 euros to sell short a Japanese bond to buy a U.S. Treasury. Okay, to cover that trade, if you have to buy it back in yen that are now 9% higher to unwind that trade, you're down 6%. Now you were parking 3% for, you're going to park 3% a year for, 10 years, but that's fine. But at some point you're going to start losing money. And so the big move in the yen is forcing everybody to go, you know what, I'm out of that trade. And if they bought any of this stuff on leverage, on margin, which almost all of them did, then their gains are, as long as the trade is in place, their gains are amplified, but it only takes a 1% move or a 2% move to blow up the trade, as opposed to a 3% move. This is the important, what leverage giveth on the way up takes away twice as fast on the way down. Yep. And it doesn't matter how complicated the trade is. If you buy a stock on margin, if you have $10,000 worth of equity in your stock account, and your broker is willing to lend you, is going to allow you to have buying power of $18,000, means you have 20% equity in the position when you put the trade on. So say you bought, I don't know, Nvidia at $100 a share. Now you go up, it goes up to 120. Your equity in that position is now higher. You bought 100 shares at $100. You had $2,000 worth of equity in that trade. It goes to 120. Your value is now $12,000. Now you have $4,000 worth of equity in the trade versus your $10,000 that you. Now you have 33% equity of it. You have $8,000 worth of leverage. You have a $12,000 asset. You got $4,000 worth of equity on $8,000 worth of debt. You have a 33% margin rate, as long as that's okay with your broker. Mazel tov. Bob's your uncle. To translate it into English. Well, the shitty English. So. But what happens when Nvidia goes to 95?
It's not good.
Now you've got $9,500 worth of equity against $8,000. When it goes to 9,000, now you've got $1,000 worth of equity against $8,000 worth of debt. At some point, your broker says to you, "Well, you've fallen below our margin level for that particular trade," and they sell your position for you. That's called a margin call, folks. I've had it happen to me. All done it. You want to ask me why I don't fucking trade? That's why. I don't know how to manage risk. Okay? I know how to describe risk, don't know how to manage it. Not particularly good at managing risk. Hell, my business partner gets on my case about this all the time. We're all bad at it.
Yeah.
Hell, we're all bad at picking stocks, no less like managing the risk of what stocks to buy. If I actually took you through the psychological process of why it is you shouldn't invest, you would never invest your money. You just buy gold and you stick it in a fucking bunker and you buy 3 dogs and you feed them every month. And you're like, yep, good. That's my vaulting cost. 150 pounds of dog food a month and some pets and some time petting the dog. Like, works for me. I'm dead serious. Like, that's what I do. Now, but I do it because I understand that I don't have the emotional temperament to do what needs to be done. Period.
I get it.
No matter all the knowledge. Doesn't get it.
I don't trade. I can read charts and everything. I don't trade. I'll just lose money. I don't have the mindset. I completely get it.
I mean, every once in a while, I may play around with a couple $100 worth of this or that. It's nothing. It's not a big deal, right? But that's not trading. No. I may move some stuff around in my retirement accounts and go, yeah, I'll move that from there. That's not really trading. That's rebalancing a portfolio. We're doing whatever. And there's, okay. So, and I can use my knowledge there in the knowledge that I have. And part of the reason why I do the technical analysis for the patrons the way I do is because I'm looking at long-term trades. So I only look at long-term charts, which match the time horizon of the investment that we're putting forth, the investment thesis we're putting forth, blah, 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 blah. I don't trade 1-minute charts when I want to take a 5-year time horizon. That just seems dumb. It's actually, that is an absolute recipe for fucking disaster. Okay.
Absolutely.
You should never look at a chart that's on a 5-year time horizon. You should never look at a chart that's less than a month.
Okay, now back to Europe.
But Europe, so back to Europe. You're so skilled. So, so Europe has the problem of they go broke if the bond spreads between different nations and the currency regime blows up. This is why they won't let the euro drop below $1.06, but the market won't let it rise above $1.10. Right? It's why the German Bund has been capped at 2.6%. Now it's like way below that, but for years I've been screaming bloody murder that Yellen and Lagarde have been capping the German Bund below 2.6%, which then has the effect of capping the French 10-year at 3% and the Spanish 10-year at 3.2% and the Italian 10-year at 4%, because all those markets are intertwined. Okay, so if you can control U.S. interest rates, then you can control German interest rates. If you control German interest rates, you control French, Spanish, Italian, Portuguese, Greek, whatever, right? The UK gilt market is also part of this process as well. And so is the Swiss franc. So all of these things are all nested. They're all nested dependencies on each other. And the one constant in all of this has been the Bank of Japan.
Right.
And they were all fat and happy as long as the Bank of Japan was allowing the yen to fall from 120 to 160. But now it's back to 145. And since in that intervening time, everybody got used to the yen trading in that, all those trades that were put on the last couple of years are all going to unwind. And they can continue to unwind and continue to put upward pressure on the yen. That the BOJ doesn't have, the BOJ and the Ministry of Finance in Japan don't have to do a thing now. They have to let it run. Now the margin calls happen. Now the liquidations happen. Now, now the trades are unwound and they just keep going. And that's why we're seeing follow through action on Wednesday, Thursday, and Friday of this week. They intervened on Monday. They knocked it down into the low 150s. That started the cascade, and then that cascade has been continuing to sell off. And then we get bad economic data out of the United States, and the thing keeps going.
Okay, now in Europe, right? So they lower, let's say they lower interest rates. That weakens the euro. Oil's going up anyway. Europe is a net importer.
Oil has just gotten crushed. Oil is now going to close the week at $77 a barrel. Right. So now the recession trade is on. Now Europe is actually in this week right now alone. Europe and Japan are both happy. Right now, this is actually benefiting Europe.
Okay.
Why? Because the same dynamic is happening in Europe that's happening in Japan. The currency is strengthening. The bond yields have come down. The price of oil in those currencies has come down more than it's come down in the dollar. It's dropped $3 and it's dropped $3 a barrel. Like 3 over 80 is what? 4% in dollar terms, but the euro is up 3%. And so it's up 3%. So therefore it's like flat. And for the yen, oil is now like down 6% or whatever the numbers are. Like the Japanese are going to be out there in the market buying up future supply of oil to hedge their markets for the next 2 years. They're going to put on long oil trades at $77 a barrel, at $2 a million BTUs of American natural gas, and then how that translates into exported LNG prices, because they buy a lot of exported LNG from the United States and from Russia. Okay, so they've got long-term contracts on those prices as well. So the Japanese have been buying the shit out of Russian LNG through the Arctic corridor, with the ruble trading at between 85 and 90 to the dollar. Right. So the Russian the Russian collapse, the collapse of the Russian ruble mirrored the collapse in the Japanese yen. Those funding costs, those energy funding costs for Japan haven't really moved very much, even while the yen was weakening against everything else, because they were out there buying Russian natural gas and refusing to go along with the Biden administration telling them they needed to stop doing so. And Japan kept steadfastly refusing, going, nope, not doing it. Buying more Russian LNG. Get over yourselves. Go fuck yourself and we'll call it even. Like, whatever you have. I mean, the Japanese are way too polite for this. They're just not from Brooklyn. So, like, neither am I, really. I'm just like, I'm one generation removed from Brooklyn. So, like, that's the key. So understanding that the Japanese are going to be sitting there piling on oil longs and long-term oil structures here, structured products, structured buy programs, all across the futures delivery curve of oil, starting now. Maybe oil drops into the low 70s. Maybe it even drops into the mid 60s in dollar terms. If there's a spasm and a liquidity crisis in the United States, that can happen. And then the inflation is going to come back. Then the money's going to circulate. And then everything is going to go haywire. But during that time, that's when you're a buyer. When oil is crashing, you should be buying it. When gold is crashing, you should be buying it. Guess what the interesting wrinkle on this? I just tweeted this out about an hour ago. So everybody's like, well, oh my God, the employment data in the US is terrible, and that's why the stock markets are crashing. I'm like, no, it's not. It's because of everything I just talked about for the last 40 minutes. That's the proximate cause today. And if you don't think that there are people withdrawing their support from, from the equity markets and taking their finger off of the equity markets and then, reverse, who do you think those people are to like exacerbate the problem? Who do you think those people are? You think George Soros is long stocks today? Is that air you think you're breathing? Nobody would be happier than to watch a meltdown of the capital markets in the United States to cause real pain than that fucking guy. And he can make money on both sides of the trade, which he will. So, oh, by the way, he's a British asset, just to remind everybody. Now, invoking my friend Richard Poe. Now, what's the next part of this? When the euro starts to roll over, right, coming into the fall, coming into the German elections in Saxony, Thuringia, and Brandenburg, heaven help anybody if the euro falls below 106. We're going to watch the rally, this rally in the euro carefully. I haven't actually looked at it this afternoon, what it actually closed at. I'm going to do that now. The euro's about to close. It's 249.
You want to share your screen?
And it's 109, and it's 109.13. Like it was trading at as high as 109.7 earlier in the day. So it's already rolling. So it's already rolling over. Like again, and the euro yen cross is now just printed below 160. This is big. Like these are big moves in the currency markets. And when the currency markets move like this, it's never good for anybody. Okay. So, well, I mean, it's never there's two things you got to remember. Is a weak currency good or is a strong currency good? Depends on the situation. Depends on what your objectives are. Depends on what your goals are. Like one of the things I note about British media, I used to listen to a lot of Nigel Farage during Brexit. I listened to like 2 years with the British media, and every time, it doesn't matter what news outlet, it doesn't matter if it was the BBC, Sky News, where Nigel Farage used to have his radio show, whatever that network was. Every one of them was that GBM. Every one of them, when they did their 7-minute, when they did their news on the half an hour thing, they always quoted the pound. Every fucking time. I can tell you that is not the case in America. We never quote the freaking dollar.
No.
Okay? They don't quote the euro in German media, I don't think. But the pound is everything. And it's used as a bludgeon to the psychological damage of the British people to think strong pound, good governance. Weak pound, bad governance. And it's bullshit.
Yeah.
The pound should be weakened when it needs to be weakened and strengthened when it needs to be strengthened. But part of what keeps City of London operating is an overly strong pound. By all rights, the pound should be trading at parity to the dollar. Like, I'm sorry, but it's being held 27% above that level for political purposes. And it's being used and managed, but not even for, I'll be honest with you, at this point, I don't even think it's being managed for the UK's purpose. I think it's being managed for Brussels purposes.
Yeah, I think so too. Absolutely, I think so. Oh, man.
I know, it's exhausting, isn't it?
I just want the EU to go away. Hurry up and collapse, please, so we can have some freedom without that Politburo ruling over.
Wouldn't it be nice if everybody would just get the fuck out of the way and allow us to like live our lives? Wouldn't that be nice?
Yeah.
I'd have to go out, but Rich, honestly, I have to go out and get a real job. And I like my current job way too much.
Tom, I'm sure there'd be other.
I get to sit here and be one of the gravy trainers, right? And go, oh, I really get to. I like being able to like be me and get paid for it. It's kind of fun, but I mean, but at the same time, I don't mind. I wouldn't mind going out if we had rational valuations. I go back and like pick up a pipette and stick some and run some numbers and do some statistics and hand people some water data. I'm okay with that. I used to do that shit. It was fun. I had no problem doing it. At my age now, I wouldn't even want to run a research laboratory. I'd be like, yeah, just give me a bench chemist job as long as I can make it. As long as you're paying me enough money to keep myself and
you do fine.
and cigars and
Okay.
what the fuck,
It was much, much better before this great bastard reset started sprouting its head and popping up everywhere. Okay.
But what was really funny, actually, just the one last note on that before we go on to the next thing, which is the following: I was not nearly as happy as I am today because I was still doing all of this shit privately with a lot more invective, if you can stomach the idea, while going to work at a job that was kind of like, it's not bad, but I'm like, I still saw all this shit. And I had no way to vent it into the public and have any purpose behind the vent other than pissing off all my friends. And then they never call me back and like, well, we can't have game night because nobody wants to talk to Tom because he's a fucking lunatic. Like now I get to be a lunatic in public and then I get to be a rational human being at home. Trade-offs. Thank you all for the support and the open air therapy, as it were. I appreciate it.
Okay. All right. Well, look, in a couple of weeks' time, you and I, fingers crossed, hopefully are going to get together with Alex Craner like we do once a month, right? So, and then we cover lots of political issues. I want to keep this one financial. So
Sure.
Any commentary on Bitcoin, gold, and silver?
Oh, sure. Bitcoin was threatening to break out above 70 grand after Bitcoin 2024 because the German government stopped announcing that they were going to sell more Bitcoin because they ran out, and everybody front ran the market down into the mid 50s, which was hilarious. I bought Bitcoin down there. I don't buy a lot, but I buy programmatically every month. I buy a little bit.
Yep.
Bing, put it away. Don't worry about it. Go, look, I made 10. I've made 10% on that money I put away last month. Gives a shit. The U.S. government starts doing the same thing. They're now selling off their Mt. Gox reserves. They've been moving the price of Bitcoin down. I think in anticipation, Bitcoin's trading at 63 right now. In anticipation of this same situation. So they're now they're trying to demoralize anybody into going into a safe haven asset. We had gold break above 2,500 this morning and then push back down into the 2470s on the futures market and above 2450 in the cash market down into the 24. It's going to probably close around 2428 or 2425 this week. Silver, same problem, had pushed all the way up into above 29. There's an interesting thing going on with gold and silver. And again, I was talking with Vince about this last night. And again, I don't know how much time I'm going to devote to it here, but because I think we do a good job of it with the two. This is where me being able to talk to a peer like Vince, we really get into the nitty gritty on these things. It's no offense, Rich. It's just like it's so dynamic, right? Right. It's a dynamic. Let's just put it this way, though. China refuses to back off. Yeah, he's more of an expert in this shit than I am. Right. I talk to Vince because I need to get caught up on things that I can't keep up with. Right. That's why I have him on the podcast so often. I'm like, dude, I don't understand this. Explain it to me. Like I'm a 4-year-old because at this point I am.
You're Vince Lance's crypto rich.
At times, yeah. Well, I mean, what's interesting is that Vince does a lot more shows than I do, and he's always done with Chris Marcus over at Arcadia Economics, and that's always a good time as well. And Chris is a friend, and I've been on his show many times, and they have great chemistry together, and they always Chris always does a great job with and allowing Vince to do his thing. Vince sees the plumbing of the markets better than I do because he's got 30 freaking years experience doing this shit, however many years experience doing this shit. It's what he does for a living. Like he's an arb guy. Like he gets arbitrage at a level that I'll never get. But what's interesting is we were talking about all of this Japan stuff and all of this yield curve control stuff, all of it in terms of China refusing to back down and buying gold. We started the podcast last night. I said, Vince, talk to me through on how the Chinese traders beat JP Morgan at their own manipulation game. The story you broke a couple of weeks ago that we were supposed to talk about 2 weeks ago that you talked with Chris Marcus about. I need you to do it for me because I don't quite understand it. So let's go back 2 weeks in time, which I know will be difficult because 2 weeks ago feels like, 30 lifetimes have fucking happened in the last 2 weeks. But, little things like Trump getting shot and, Biden being cooed out of office and hunted out of office, the Biden junta being hunted out of office. We're now 2 juntas down in the United States. I'm just waiting for the next junta. That'll be at this convention. And so he started to explain it to me that the TLDR, for those who don't really care about this stuff, is that a bunch of Chinese traders beat JP Morgan at their own manipulation game and getting and standing for delivery and fucking up the gold and silver market by keeping it overly strong and then standing in Shanghai. And they just overwhelmed the standard set of JP Morgan and Goldman Sachs traders who are usually playing this game, and HSBC and a couple of others. But they're screaming about this. China's manipulating the price of gold up. Yeah, bullshit. Like, you can't manipulate the price of gold down, which is what you wanted to do. Because it's always in their interest to do so, because if you can manipulate the price of gold down into the end of the month towards futures delivery, then you can get longs who are in the money and ready to stand for delivery, then get the price of gold under that price. Then they may not stand for, a lot of them may not take delivery because it's not in their best interest to do so, because they have no place to arbit somewhere else at a higher price. But with China constantly running a higher gold price arbitrage over the price of gold, people are standing for delivery, even if they're $2 upside down or $3 upside down in their futures trade, because they're going to make $30 in China.
Mm.
So if they're long gold at 24.20 and gold runs to 2,500 and then somehow miraculously gets pushed down to 24.15 on futures expiration day, which is what always fucking happens, then those guys that were $70, $80 in the money at 2,500 are now $5 in the hole. Or maybe they get it down to 24.25. It may not be worth their time to stand for delivery. They'll just take cash and not stand for delivery because it's only $5. There's only $5 an ounce, and there's no way for them to sell the gold to make the that they actually want. And some guys are in there to collect the gold, and that's fine. But there's a lot of speculators who don't actually want the gold; they want the dollars.
Yeah.
So China, by constantly ratcheting up the premium over New York, London, and by pushing the futures price on our exchanges above the spot price, what they're doing is they're forcing delivery onto the bullion banks that don't want to make those deliveries and want to be able to come in, bomb the market, and move it where they need to at the end of the month. Long story short, Chinese traders have infinitely deep pockets because half of them are backed by the Chinese government. So China officially isn't buying gold and hasn't bought gold for the last 3 months. But unofficially, as Vince explained it, they are. But they're doing it through third-party subsidiaries, which then allows India to take up the official slack in buying gold, because India's been adding to their gold reserves. So it's another way of China throwing India a little bit of a bone that way as well. And everybody's playing this game. What's interesting about all this is that what I was saying this afternoon on Twitter, was like, we got this Japanese yen thing, we got these carry trades blowing up, and during these incipient liquidity crises like this, gold is always sold first. So is silver. Why? Because this is the cheap source of funds. It's a way to park dollars. It's a way to hedge against real interest rates collapsing or whatever. And so guys put their gold trades on in order to be able to use gold as a piggy bank for dollars when they need, because they know they can sell that gold future and it's cash. So parking in gold is like parking in cash, with the potential upside of making money on a rising gold price. Gold is always the first thing sold in any kind of dollar liquidity crisis. Well, what if it doesn't happen this time? What if the Chinese stay under the bid? What if they keep the gold price if it doesn't collapse now? Normally, like in a situation like this, you see gold collapse $100, not 30. What happens? More guys stand for delivery.
My God.
You claim you drain the COMEX and the LBMA that much faster. You put the bullion banks even farther behind the curve. Okay, behind the 8 ball. Part of what I've been arguing.
Hold on, Tom.
I think I just blew your mind.
Which is bad for the Western currencies.
Well, what it means is that no, because I think the game is like four layers deep, even deeper than that. Going back to previous conversations between myself and Vince, what are we staring at? The return of mercantilism, the return of gold-backed domestic currencies and non-gold-backed international versions of the same currency. China has that. They have the onshore yuan and the offshore yuan in a closed capital account. Japan doesn't. They have an open capital account. The United States has the world's biggest open capital account. We are the world's reserve currency. But what if we're trying to move to a soft capital control environment where physical gold doesn't leave the United States, but you can still speculate on gold and the gold price in dollar terms to hedge your FX risk, your foreign exchange risk, using GLD and SLV future options as opposed to COMEX and LBMA futures. Mm-hmm. Therefore, you shift that market away from those guys. You collapse those markets and move into the ETFs, which are under no obligation to actually give you physical gold. And the only people who will be allowed to sell at large tonnage. I'm not talking about your gold dealers being shut down or anything. That's not what I'm saying. I'm talking about there's a central bank out there that wants to buy 500 tons of gold. That has to be approved by the U.S. government through their trusted intermediaries, which in this case would be J.P. Morgan and HSBC, who are the trustees for that, or the trusted intermediaries who will actually deliver the metal.
Mm-hmm.
Okay, so it's a soft capital control environment. So now the question for you, for the audience is, because I think I've already led you there, is what if this was all part of the plan? We want the Chinese to stand for delivery and force the COMEX and the LBMA into collapsing so that we can affect our desired outcome, which is to allow people to speculate on gold and silver through GLD and SLV and deprecate completely the Chicago gold futures contract. We don't need to use it as a manipulation tool anymore. It's outlived its usefulness as a price manipulation tool. Therefore, let's get the fuck rid of it. We can't stop the Chinese from buying anyway. Let's go with the flow. Now let's take it one step further. This is what I talked with Vince about last night. And I'm going to leave it here after this. I think you and I want to do a little over an hour. I want to stop here because if I go too long, then I start to get really tired.
Yeah.
This is following. And I start saying terrible things I'm not supposed to say.
Sometimes you start that way as well.
Yeah. I mean, F-bombs are allowed. Like, it's other things that I'm not allowed to say, and rightfully so. Like, at this point in time, like, let's not kid ourselves. Like, we don't live in a free speech world. There's that.
Yeah.
And there's decorum. Let's just get over ourselves. Now, the next step in all of that is, what if that's the case, we're moving to that phase of it, then what have I been saying for a while now? There will be a negotiated settlement between the price of gold, the price of the currencies, the national debts, and everything else based on the size of the Fed's balance sheet, the national debt, and all the rest of it. At some point, gold is going to be allowed to rise to a certain level that our reserves are certain percentage of the Fed's balance sheet. As of right now, it's not very much. The Fed's balance sheet is $8 trillion, and the gold, 80 to 100 tons of gold at $2,450 an ounce is not that much money. It's, I don't know, $500, $600, $700 billion. It's south of $1 trillion. Doesn't matter. It's 10%. It's 8% of the Fed's balance sheet. Well, to restore trust in the Federal Reserve and the monetary system of the United States, that percentage is going to have to be a lot higher. Is it 20%? Is it 30%? Is it 40%? 50%? I don't know. That's up to my fellow Americans to decide. Okay? And we'll know that if Donald Trump wins the election and we start to see the process of moving towards Judy Shelton's gold-backed tips, which will circulate only domestically as digital dollars domestically. But they'll also only be those types of instruments, I expect, will only be offered to U.S. citizens, not to foreign assets, only to U.S. citizens to reinvest in America, getting a claim against a certain amount of Treasury gold at the end of the bond. And that's how you start to balance the budget. And you pay these people off in a rising price of gold, as opposed to more dollars by paying them a coupon on the bond. So as opposed to paying them 5% on a $10,000 bond and paying them $500 a year in interest for 10 years, you let the price of gold rise by 5% every year.
Yeah.
Then you just redeem the Treasury gold at the end. And you've tamed inflation, you've tamed all this stuff, and it's only available domestically. How do you control the domestic dollar? I hate to use the phrase, folks. You do it with a CBDC. But it's not the CBDC, it's Christine Lagarde's dreams, where an AI will tell you that you're a bad person, so you don't get to buy a pizza. And that she wants 100% tax collection. It'll be a CBDC of a different variety. It will be a central bank digital version of the US dollar that circulates domestically, with the idea of it being a domestic dollar versus the international or euro dollar. Now, here's another one that fucking blew my mind. I was on with Marty Bent. I think it was Marty Bent. Or was it somebody else? I can't remember what show I was on. And somebody said to me, and so now, Tom, I want to throw the idea at you that Tether is going to be the new euro dollar.
Wow.
Wouldn't that be a kick in the pants? Which is another reason why why Trump is out there saying, yep, sounds like a strategic Bitcoin reserve seems like a good idea. Same thing with RFK. Why? Because they understand. Trump may not understand all of that, all of what I just laid out. I think he does understand a lot of this stuff a lot better than people want to give him credit for. But what he does understand is collateral and debt. And he understands how to collateralize obligations and collateralize complicated trades. This is how he made his money. Being a broker between 5 different freaking people and putting none of his own money in the game. And then coming out the other side with an equity stake. Fucking guy's brilliant. Okay? I mean, so, like, the pieces are all there. The question is whether we're going to be allowed to cross the finish line by getting the guy across the finish line in November and then to January without some other terrible thing happen. Yeah. Am I right? Am I wrong? I don't know. All I'm telling you is that this is what I'm seeing. And then when you put that together with the podcast I did with Pete Canones over big tech versus little tech and the PayPal mafia and all those guys, you start to see a pattern emerging here. And the people who are screaming the most are the ones who are representatives of the old guard.
Yep.
And the game is being played across multiple stages, which are far bigger than any one layer. So Japan, China, the United States, trust me on this one, this is all coordinated. The Chinese are happy to watch the Japanese strengthen the yen. That helps the yuan. Allows China to export more in the face of high U.S. sanctions, high U.S. tariffs. Okay? Trump wants to come in and put on more tariffs. Why does he want to do that? To force the Chinese to the negotiating table. We need a negotiated settlement across so many different vectors. We can avoid all of this without a fucking war. You know who loses this? You know who loses in this? Europe and the British and the remaining British remnant. Those are the big losers in this. But even Europe can find their way out of it. They just give up the EU and begin the process of taking care of their own security architecture and stop trying to rule the fucking world. And start paying something close to fair market value for their commodities, and then go through the painful reorganization of becoming an innovative, vibrant economy again, as opposed to a sclerotic fucking welfare state. And is the takeaway that every hard money advocate should welcome. And if it takes the quote unquote dysfunctional BOJ and the rapacious Fed and the evil guy and that evil guy to affect that outcome, would we not want to see the end of the old colonialist European order? Would that not be good for humanity? I'm not saying I want to replace it with the Chinese colonialist impulse. No. Not what I'm saying. Not what I'm saying. Not what I'm saying. And that is why that's what the power that's left in the United States, that's what we have left. And we should use that asset to our greatest advantage. And you should be cheering that fucking Trump wins this election.
Yep, absolutely.
You should be praying to whatever God you believe in. Because those are the stakes. And I see it more clearly now than I ever have.
Tom, thank you so much. Thank you for tying it all together in that way. And in a couple of weeks' time, you, me, and Alex, and then we can talk about things like political issues. And I do think I just got to say this, and then we're going to finish up. Right? Is that they are going to do something to mess up that election. They are going to do something, delay it, disrupt it, something.
Guaranteed.
Something absolutely
guaranteed.
It is going to happen, and which is why it's important for people to stay sharp. Get gold. I don't often say this, right, on my channel, but
stay sharp. Trust no one. I'll leave the third part off for the people in the audience who know how that phrase ends, but you have to be a geek like me.
Okay.
We'll talk again.
We absolutely will. I'll have a link to tomluongo.me in your Twitter, and you can find those podcasts through tomluongo.me. And if you have any comments or questions, put them in the description below. Make sure you subscribe, share this video everywhere. And Tom will be back next time, hopefully with Alex Craner, and we'll be talking politics. Tom, thank you so much. All the best. Bye-bye.
Bye.